Good afternoon, everybody, and welcome to my Facebook and Zoom live webinar on what's going on in the market in 2022. Kind of having a hard time still trying to say 2022. Anyway, thank you all for joining me. I've got a group of people still streaming in here on Zoom, and we're broadcasting this live on Facebook as well. If somebody can give me a chat message in the Zoom chat, just telling me, yes, John, we can hear you and we can see you, I would appreciate that, so I can get a quick video and audio check from somebody. Thank you. Anybody? All right, well, I'm gonna keep talking, assuming hopefully somebody will tell you, yes, thank you for a few of you telling me. Perfect. All right, so we're gonna dive right in. I've got a lot of stuff that I want to cover today, and so we're going to get going right away. If you have questions for me, feel free to post it into the chat. I will not be monitoring Facebook chat. I'll catch up on those later. I am monitoring the Zoom chat, so feel free to ask questions on there, and let's go ahead and get started. Okay, what are we gonna cover today? We're going to talk about a lot of stuff at a really high level, but these are things that you can really use with your clients. If you're a realtor, if you're a home buyer or a homeowner and just trying to understand what's going on with the markets, I'm going to give you kind of a high level overview. We're in some crazy times, and we thought 2020 and 2021 were crazy. We're going to see a lot of volatility over the next year or so, and I'm going to cover a big picture overview of what are economic cycles and where are we now. We're going to talk about inflation and why that's a really big deal. And what is the Fed's plan to combat inflation? We're talking about the prime rate and how that in fact impacts mortgage rates. We're going to talk about why rates have been going up so much recently and where they're headed this year. And then I'm going to give you some long-term ideas of what I think is going on for housing prices, interest rates, the stock market, and economic cycles in general. So we'll have a little bit of time at the end for Q&A as well, and I'm hoping you guys are going to get a lot out of this. So away we go. Economic cycles, what are they and where are we now? The first thing I want to explain is the economy is measured in something called GDP. And it's basically the total value of all the goods that are produced inside of the borders of a country. So every home that you sell goes into the GDP. Every car that Elon Musk produces, every Tesla that he produces, the price of that goes into the GDP. And an expansion or a recession has to do with, are we increasing the amount or value of goods and services we're producing, or is it decreasing? So these are all the different things that go into it, but basically it's everything that is produced in the economy. And that basically has to do with the economic cycles. So this blue line is the economic cycle, and obviously it's going down is bad and up is good. But what the economic cycles are tracking is GDP. So it's tracking gross domestic product, and it's talking about, is it growing or is it shrinking? So think about, as a real estate agent, if you did $5 million in sales in 2020, and in 2021, you did $4 million in sales. Well, that's $4 million is still a good number, but you're shrinking. The size of your business is going backwards. That's not a good sign. The same holds true for the country. If the number of goods and services we're producing is shrinking, that's bad. There's a lot of problems that come with that, and that's what we experienced in early 2020. We had a recession. We had a decrease in the production in GDP, and the economic definition is 3 consecutive quarters. So 9 months straight of GDP going down. That's a recession. And where we're at right now, we're right about here on the timeline. Okay, maybe even right about here, in my opinion. What this red line represents is the stock market. And the stock market was super low in 2020. It dropped in 2020. It then started going up significantly. And what's funny is this chart tracks kind of the sectors in the stock market, the groups of industries that do well in different parts of the cycle. And we had a huge boom in technology in 2020, 2021, and that's what we call a bull market. If you don't know why they call it a bull market, think about literally a bull. How does a bull attack? It attacks upward with its horns. So a bull market means that it's attacking upward. The opposite's a bear market. How does a bear attack? A bear claws down at you with its front paws. So that's how a bear attacks. So a bear market goes down, a bull market goes up. You didn't know that, now you do. what's happened right now is I feel like we're pretty close to the top, if not a little bit past the top of the stock market. And we've seen that in the last week or so, this week really, where the market has really started feeling major pain. And it's inflation that is creating the major pain right now. And I'm going to talk about inflation in a couple of minutes. But here's what I see happening with the stock markets. I see the stock market having trouble this year. I think it's a great buying opportunity. I think it is exactly the same as what happened back in 2020 when we saw the stock market tank in March and in April of 2020, and we saw a huge volatility. But from there, it went way up. And that was a short cycle where the market dropped and then it came way up very quickly. And we've been going up ever since summer of 2020, really late spring of 2020. But we're at the point right now where I think the stock market is going to start falling, but the economy is still super red hot and it is still growing. The problem is inflation, and I'll explain inflation in a minute. But what I want to explain real quick here, and I think I jumped ahead, the bull market versus the bear market for the stock market. We talked about bull market, which is really what we are just coming out of, in my opinion. The economy is expanding. Unemployment has been falling. Unemployment is super, super low right now. At a certain point, too low of unemployment is a bad thing because now there aren't enough workers to produce the goods. And that's a big part of what's causing inflation. So enough on that. I want to kind of not spend too much time on the details of some of these topics. I want to talk high level and dive in on the ones that I think matter the most. Again, guys, if you have questions about any of this, please feel free to post it on chat, and I will on the Zoom chat or on the Facebook chat, and I will comment on the Zoom chat as I go. But let's dive into inflation. And I actually found a website called Napkin Finance, and it actually does a really good job of explaining complex information written literally on a napkin. And so what is inflation? Inflation is simply the increase of the cost of goods. We've been seeing that a lot in the last 12 months. We've seen the price of gasoline go up. We've seen the price of food go up. We've seen the price of just plain anything and everything. One of the biggest recent increases in inflation, used cars. Used cars and trucks, the prices have skyrocketed. And so somebody who needs to buy a used car right now, they're being priced out of the market. Obviously, housing prices are doing the same thing, and that's part of the concern. And inflation is measured by what's called the Consumer Price Index. Here's the deal with inflation. Everything in life has good and bad qualities. Inflation is no different. So inflation, good news is you get higher paychecks. It does help the economy grow, or it can help the economy grow. So right now, again, the economy's red hot. Businesses are making really good money. They're investing into their people. They're investing into processes. So businesses are growing. That's super, super good. And it actually helps borrowers. Here's why it helps a borrower. Not somebody who's about to borrow money, but somebody who already did. Because somebody who bought a mortgage just a year or two, bought a home just a year or two ago, their wages are going up right now. In general, wages are going up, and they are spending money that they're making more money now, yet what they borrowed the money at is at a lower cost based on the fact that they took out the loan a couple of years ago. The opposite is true for lenders. Lenders are in trouble right now because lenders are saying, hey, inflation last month went up by 7%. That literally means that the average item last month cost 7% more than what it cost in December of 2020. Yet a mortgage company is only earning 3% interest on their loan. That means we're losing money right now because the dollars that people are paying us, inflation is growing by 7% and we're only earning 3%. It's a losing proposition for lenders, and it's why banks are increasing their interest rates significantly right now. Because the problem is the interest they're going to earn tomorrow won't be worth as much. And I'll explain this using the Big Mac index. Okay, there's actually a literal Big Mac index, and it talks about inflation relative to what is the cost of buying a Big Mac. And there's a research company that's been tracking this for years and years and years in different countries of what the cost is of a Big Mac. But if you think about it, if a Big Mac 10 years ago costs $1, and 10 years ago, you were a lender and you said, you know what, I'm going to loan you $500 and you're going to pay me back $1 a month. Okay, well, that's cool because as the lender, I know that every single month I can buy a Big Mac. The problem is that now a Big Mac costs $3 because inflation's gone up in the last 10 years by 300%, as an example. So I can't buy that $1 that I'm earning every month. That doesn't buy me a Big Mac anymore. It buys me 1/3 of a Big Mac. In other words, I have to wait 3 months of income on that loan before I can afford to pay for that Big Mac. So inflation makes the future value of money worth less. It doesn't buy as many Big Macs in the future. And that's what banks are worried about. That's a big reason why inflation is very, very bad. And also, too much inflation is bad for growth. So inflation helps the economy grow. Too much inflation hurts the economy's growth. And I'm going to talk a little bit more about that as we go forward. So basic stuff about inflation. First of all, it is too much money chasing too few goods. Gang, we have been experiencing inflation in the housing market for the past 2.5 years. We have been experiencing too many people chasing too few homes, and that is significantly driving up the price of homes. But what's happened recently in the last 12 months is that's now gone across everything that we purchase, and it causes the prices of goods, the stuff that you buy, the services you pay for, to go up very, very quickly. It makes your money less valuable. I think I've gone pretty well into that. What I want to do is take a couple of minutes and look at kind of the history of inflation and what does this really mean and how does it play out. So I'm going to grab this chart from over here and bring it over here. All righty, and are you going to open for me? Yes, you are. Thank you very much. This is the average amount of inflation, or the actual amount of inflation every year. So basically, some inflation is good. If you think about your salary, if you're working for a salary, if you're a realtor, well, you're not working for a salary. But if you think about your salary, you would not be happy if every year your wages stayed exactly the same. And the same holds true just across the board in the economy. Employers need to pay their employees more. Therefore, employers need to be able to raise the price of the goods that they're selling. There's a healthy amount of inflation. Healthy inflation is 1 to 2% inflation. Okay, so what we're seeing is back in the 60s, we had about 1% to 2% inflation, jumped way up in the 70s, early 80s, we had the highest inflation that we've had. And then inflation comes way down. And it becomes pretty stable until we hit the Great Recession in 2008. And then inflation went way down very, very quickly. That was in the middle of a recession where the prices of things dropped significantly. Home prices were a big part of it. And then it rebounded real quick. So the thing that you notice is these are pretty sharp moves. Now, granted, this is over a multi-year period. So from 1978 to 1980, inflation grew significantly, but it fell pretty quickly thereafter. We were talking about another 2 years or 3 years after that. And as you can see, the cycles are getting shorter. The time from the high to the low, back up to the high, is shortened compared to what we saw over here. And that's one of the themes I want to point out right now. I firmly believe that these cycles are becoming more compressed. It really has to do with the type of economy that we're in. We're in a global economy, we're in a technological economy, and things move quickly, which means information moves quickly, it means that goods move quickly, and it means that these cycles move quickly, and we're going to see compression in how long these cycles last. But it's actually the fatal mistake the Fed made in the last 6 months. We'll talk in a couple minutes about what who the Federal Reserve is, but I'll tell you right now while I'm thinking about it, the challenge is the Federal Reserve over the last 6 months said this inflation is temporary. Once COVID's over, and once this supply chain issue is over, we had all the issues with all of the ships off the port of Los Angeles that were backlogged. Once we get that backlog cleared of all the ships that are off the port of Los Angeles and the port of Long Beach, then we're not going to have inflation anymore. It'll be gone in a month or two. They were wrong. They were very, very wrong. And the problem is now they're behind the 8 ball because they haven't actually taken any steps to slow inflation. The Fed's goal is to have inflation average 2% per year. That's great. 2% inflation on average is fine. But last month we were at 7% inflation. That is not healthy. That borderlines what's called hyperinflation, and it's a pretty serious concern. And that's really why we're talking today. So why is this bad for the stock market? Inflation is bad for the stock market because companies they run to a point where they have to spend a lot more money for employees, and therefore it's eroding their profit margin. B, they're in a position where interest rates are going to be going up, and that's going to make it more expensive for them to borrow money. That's part of why our economy's been so hot right now, because the federal government 2 years ago said, hey, we think COVID's going to be super bad. And they're right, at least from the economic perspective. There was a major problem with COVID and people's ability to work and to produce income. And so they lit a match. And they said, we're going to light this economy on fire. The problem is they pulled out a bazooka when they should have maybe used a machete. And that bazooka lit it's a flamethrower, let's say it that. So they should have used a lighter to light it on fire, and instead they pulled out a flamethrower. It lit the economy on fire. And it's creating what I'm calling manic reactions in the market. And the stock market does not like unpredictability. So the fact that we can't predict where inflation is going, that the economy is swinging so quickly is bad for the stock market, and it's super bad for the bond market. And this is really the concept I was talking about. Oops, I should be able to get to my little link here. Oh, I can't get to it. All right, anyway, I don't care. What we're looking at is the 10-year treasury is a bond that you can purchase from the federal government. And it basically says the federal government's going to pay you 2% interest. Right now, it's 1.8% interest per year for the next 10 years. It's guaranteed income. Any one of you right now can go buy a 10-year treasury bond. You're guaranteed to get 1.8% return on the money that you gave the government. The problem is, if inflation stays at 7%, you're actually losing 5% every single year, because the cost of everything we buy increases by 7%. Your money only grew by 2%. It's still costing you 5% more than what you earned to simply continue living. And that is why mortgage rates are going up, because mortgages are a bond. It is a fixed amount of income that the bank is going to earn over the next 30 years. And it's not going to keep up with inflation if inflation stays rampant the way that it is. Now, I don't think inflation is going to stay rampant the way that it is. We saw the chart shoot up. We saw it shoot down. I think the cycles are going to compress. But the reality is the market does not like the volatility, and the concerns are well beyond what the federal government predicted. So how did we get in this much trouble? Let me explain. First of all, another great napkin finance outline. The federal government keeps the economy on track in two ways: fiscal policy and monetary policy. Now, fiscal policy is the federal government deciding, hey, we're going to spend money, and the money that they're spending on road construction and bridges, that helps spur the economy. Or they can add taxes, and that helps slow down the economy. Now, that's a longer term steering that the federal government can do. So that's not something they can turn on a dime, but the Fed with their monetary policy can turn on a dime. And the Fed can do that in two ways. They can raise and lower interest rates. I'm going to pause here for a second. This is one of the most misunderstood pieces of really monetary policy and interest rates in general. The federal government does not control mortgage rates. Everybody confuses that. Even some realtors I know confuse that. The federal government said last month they're going to start raising rates in March. A lot of people think, great, then I need to get my mortgage before March when the federal government raises rates. The government doesn't control mortgage rates. It controls money being borrowed from a bank by a bank. The federal government loans money to banks overnight. Let me say it that way. And that is what the federal government controls. And when a bank is borrowing money because, hey, I loaned out so much money and I received so much money in deposits, and tonight I'm short by $10 million because I've loaned out more money than I've received in deposits. They go to the federal government and they say, knock, knock. They knock on the discount window and they say, knock, knock. Can I have $10 million until tomorrow? Because tomorrow I know I'm going to get some more payments on my credit card bills. I know I'm going to get more payments in on my mortgages. And I know that I'm going to get more people depositing their paycheck. But I need $10 million to make it overnight. Can you help me out? That's the rates that the federal government controls. They do not control mortgage rates. I'll explain in a minute more about how this plays out in mortgage rates. But the other thing the government does is they buy and sell securities, specifically treasury bonds and mortgage bonds. And that's what the government's been doing since March of 2020, is buying a significant amount of securities. And that's what we call quantitative easing. And they jumpstart the economy by buying bonds. And that causes, if it's supply and demand, and if the government is buying all of these mortgages, then we don't have to raise rates to find buyers. We can lower interest rates because, hey, as soon as we put out a mortgage, we have people dying to be the investor and buy them. So rates drop. But if we don't have a lot of people that are dying to invest in those mortgages, we have to raise rates in order to tempt them to say, hey, nobody wants to buy this mortgage. I got $1 million mortgage right here, and you can have it for 3% per year. And crickets, nobody wants it. Okay, well, how about 3.5%? Does anybody, do I hear 3.5%? Crickets. Okay, how about 4%? Does anybody, if I gave you $1 million mortgage as an investment and I paid you 4%, would you do it? Somebody raises their hand and says, yep, I'll do it. That is literally the trading of mortgage bonds and how it works. Super oversimplified, but that's exactly what's going on. The government has been the largest buyer of mortgage bonds since March of 2020. They've stopped buying new mortgage bonds, and now they're doing something that is called quantitative tightening, which is the opposite. So they were easing and they were buying a whole bunch, and now they're going completely the opposite direction. And it's kind of like when you're driving down the road, like what you're seeing right here, and you overcorrect. And you can see this person was drifting to the left and they, oh my God, I'm going to fall off the side of the road on the left. And so they overcorrect, and where do they go? All the way to the other side. And then, oh my gosh, I'm about to go off on the other side. So what do? They overcorrect the other way. That is literally what our economy is doing right now. It is what the Federal Reserve is doing right now. They, by ignoring inflation and thinking it's going to go away in a month or two, allowed us to basically almost get into the dirt on the side of the road. And now they're yanking the steering wheel as hard as they can the other direction. But that's not how you go straight. You edge a little bit each way, but instead they're yanking the steering wheel as hard as they can. We're going to head off into the ditch on the other side. I'm going to explain to you what that ditch looks like and what that means long term. So let's talk first about what the Fed's plan is to combat inflation. 2 steps: quantitative tightening. Again, that's the opposite of quantitative easing. I'm using a chart to simply explain the last time the Federal Reserve used this tool of quantitative easing being buying mortgages and buying treasuries. And the Federal Reserve in 2009 said, we're going to buy a whole bunch of mortgages. And then they said, we don't really want to keep them anymore, so we're going to sell them. And then they decided, oh, wait, hold on, we goofed up. We shouldn't have sold that many of them because the market's hitting some challenges. And so they said, okay, we're gonna buy some more. Well, then they sold them all again. And then they said, we're gonna buy some more and some more. And they decided to hold on to them for a longer period of time until finally they slowly unwound how much, or sold the mortgage bonds and treasury bonds that they owned. The Fed's kind of right here right now. They bought a whole, obviously forget the year, they bought a whole bunch of mortgages and treasuries over the last 2 years, and now they're going to unload them over the next 3 months. That's what caused mortgage rates to go up in the last month, because the Fed said back in November, we're going to take 6 to 12 months to unwind the debt that we have purchased. And in December and early January, they said, maybe we're not going to take 6 to 12 months. Maybe this inflation thing's a bigger deal than we thought it was. How about if we just get this unwound by March? So in the next 3 months, they're going to be selling a whole bunch of mortgage securities, and that is going to put a lot more supply. They're not going to be buying anymore, but they're also now going to be selling. We're going to be competing with them to find investors willing to buy the mortgages. And that's going to continue to drive rates up. And that has nothing to do with the Federal Reserve's prime rate. That's step 2. But the quantitative tightening, the selling of mortgage bonds, is the exact opposite of what they did back in March of 2020 and buying mortgages. They held them for the last 2 years, and now they're going to quickly liquidate them. Think about the foreclosure crisis, and this isn't going to lead to foreclosures. What I'm saying is when you got a bunch of homes that all want to sell at the same time, the prices drop on them because you have a bunch of sellers and you have very few buyers. That's what's happening. But the price of a bond is not the rates. The price goes down, the rate goes up. I'm not going to get into why that is true, but I'm just being super clear. When the prices drop because there's too many people selling mortgage bonds and not enough buyers, it means the rate's going up. Step 2 is the Federal Reserve increases the Fed funds rate. And so this is really giving you an idea of what everybody sees as, okay, this is what's going to happen with interest rates. The Fed's raising the Fed funds rate. Remember, guys, this is step 2. Everything that led up to this is why mortgage rates are going up. This has nothing to do with mortgage rates. The reason the Fed is raising the funds rate is the same reason why mortgage rates are going up. But the increase of the Fed funds rate is not a cause and effect relationship. It does not cause mortgage rates to go up. And I'll give you a quick idea of the federal funds rate and where it's been and what I think our worst case scenario is. So back to 1955, and it was in the 2s, and it dropped a little bit, and it's up and it's down, and the worst that we had been was in the 80s. Okay, significant reinflation, significant recession. Rates are really, really high. By the way, on these charts that are from the Federal Reserve, the FRED, all of these gray areas are recessions. Okay, so we've got back-to-back recessions. Hence, I think we're going to have back-to-back recessions again. It's one of the things I'm going to get into. I think we're headed for a recession in the next couple of years, and it's going to look very much like this. The recession in 2020 was really, really short. Kind of like the recession in 1980 was really short, but the recession in 1981, that one lasted almost 2 years. So that's the one I'm concerned about, is the next recession. This recession we just had in 2020 may seem like, for those of you that had lived in the Bay Area and had earthquakes growing up like I did, that's kind of the precursor, the early warning earthquake that's coming right before the big one. I'm concerned. Now, don't misunderstand. A recession does not mean a drop in housing prices. A recession does not mean interest rates go up. As a matter of fact, most of the time it means the opposite. But I want to be super clear. The Federal Reserve has historically never had their interest rates anywhere near zero until 2009. And between 2009 and 2015, they were almost at zero the entire time. And then they said, oh, everything's good with the economy now. We're going to raise rates. And then COVID comes along. And bam, rates come back down. They're now going to go back into one of these quick increases in rates. But watch what happens when there's a quick increase in rates. What do we hit? A recession. Quick increase in rates. What do we hit? A recession. Quick increase in rates. What do we hit? A recession. Increase in rates. A recession. Are you seeing the pattern? As the Fed is, and it's not because the Fed raised their funds rate that caused a recession, but the factors that are going on the economy, where it's heating up too quickly, the Fed pumps the brakes and says, okay, I'm going to slow down the economy by raising interest rates. But they slow it down too much, and it inevitably leads to a significant recession. That's the pattern I want you to see here. As the Fed raises interest rates, you hit a recession. Raises interest rates, you hit a recession. Raises interest rates, hit a recession. Raised rates up to 2019, hit a recession. Guess what we're about to start doing right now? The pattern is the pattern. That's the piece I need you to understand out of this. As the Fed raises the Fed funds rate for a period of time, I think we're probably looking at about 2 to 3 years at most. I really think by the end of 2024, we will hit another recession. And it's because of this factor of the Fed pumping the brakes, overcorrecting the other way because things are too hot, and we're going to go off the side of the road on the other side. All right, guys, I know I'm covering a lot here. I want to pause for a quick second and make sure you know that you can ask questions. So if you have a question, if you need me to repeat something, I'm happy to do so. This is recorded and it will be posted on my YouTube channel tomorrow. So if you want to watch it again or share it with somebody, please share it on my YouTube channel. I would very much appreciate that. Hopefully this is all valuable for you. So let's talk about that prime rate and how it really does impact mortgage rates. It doesn't. I just want to put that in there to make it super clear. I think I've said it enough times over the last 5 minutes. The Fed funds rate, which by the way, the Fed funds rate, the discount rate, the prime rates, different ways of saying something similar. Prime rate is a different version of it, but the bottom line is it's tied to the same thing. The prime rate's tied to the Fed funds rate, the discount rate's the same. So when the discount rate or Fed funds rate goes up, so does the prime rate. So it's tied to each other. Mortgage rates don't change. What does change is the rate on variable lines of credit. Your credit card rates are going to go up. Your home equity line of credit rates are going to go up. If you have any debt that is a variable interest rate that you have no inclination to pay off anytime soon, now is the time to make it a fixed rate. And don't be concerned that I missed the boat because, oh my gosh, rates were lower a month ago, because those rates on those variable loans are going to skyrocket over the next couple of years. That's the concern. It's not going to impact mortgages. It's going to impact variable interest rate debt. That's what you guys need to be concerned about. And that's what we need to be spreading the word about. So why have rates been going up so much recently? I've kind of alluded to this, but I want to make it super clear. Everybody sees the future. We're there. We know what's going on with the economy. The economists are paying attention to everything that I just showed you guys, and the market sees the same thing the Feds see. So we've got rates going up simply because, most importantly, inflation. I've already explained why. Inflation is hurting lenders, because they're now losing money. Inflation is greater than the money we're earning, and nobody wants to be in that position. So lenders are making up for it by raising future interest rates. And I already told you the Fed is going to be a seller of mortgage bonds. Therefore, there's going to be more mortgage bonds out there that we have to find investors to invest in. And we've got to offer a higher interest rate to give an incentive to those investors to invest in it. All right, somebody asked me a question about the name of my YouTube channel. It is simply John Loan King. So go to youtube.com/John, John, Loan, Loan, King, King. Okay, so where are rates headed this year? Here's the deal, gang. Mortgage rates, I think we're hitting 3.5 to 4, right? Excuse me, currently we're 3.5 to 4.25. I absolutely believe that we're going to hit the mid to high 4% range before we top out. So we're going to see mortgage rates. I don't think it's a straight line up. I think that we're going to see, as a matter of fact, what's interesting is that today rates got a smidge better than yesterday, not much, but a smidge better than yesterday. And we're going to see kind of a up and then flat and then up and then flat, but we're going to see rates continue to move up for all the reasons that I've talked about so far. But thinking back to 2018, when rates had really spiked in the last cycle, rates stopped at around 4.75. And I believe, just like I talked about the cycles compressing, the interest rate range is also compressing. We're going to see lower highs each time that we move forward, and hopefully, yep. So this will kind of help as you're looking at, hey, rates went way up, and everybody's always said, oh my gosh, rates are going to go up to 15, back up to 19% like 1981. No, they're not. When they fell and they went back up, the next high was 11. Then they fell and they went back up, and the next high was 9. They fell and they went back up, and the next high was 5. And this is the Fed funds rate, not mortgage rates, but the concept is exactly the same. And so the high water mark is lower each time. And so I don't think we're going to get above the 4.75 to 4.99 on average. But here's the deal. When we were at 4.75 to 4.99 back in 2018, it created some major challenges for people who wanted to move up, because they had two problems that they were facing. We're going to run into the exact same two problems. Sellers aren't going to want to sell because A, they have a rate that is significantly lower. Matter of fact, I'm thinking of a client that I had talked to back in 2018. He had bought his house in 2013. He had bought it for $200,000. and it's now worth $400,000. And he said, John, I want to sell my house and buy a $450,000 home. And I talked to him about his payment, and he was shocked to find out his payment was going to double. He said, how is it going to double? My house is worth $400,000 right now, and I only want to trade it for a $450,000 home. And I said, well, let me walk you through the math. First and foremost, your property taxes. Your taxes in California are based on what you bought the house for, with minor increases every year. So his property tax basis was around $220,000, and he's going to buy a $450,000 home. That doubled the dollar amount of his property taxes overnight. The second thing is, when he sells his home for $400,000, he's going to have commissions he's got to pay on that. So he's going to spend $25,000 in commissions to sell the home. And then he's got closing costs on the new loan. So he's going to have another $10,000 to $15,000 worth of costs between moving expenses and closing costs. He's probably closer to $40,000, $45,000 spent to move from one house to another, which means he didn't get $200,000 out of the sale of his home. He only got $150,000 out of the sale of his home. So when he buys that $450,000 home, he's only got $150,000 for down payment. So his loan amount went from $200,000 to $300,000. He expected only a $50,000 increase in his loan amount, but the rate went up significantly as well, because he had a rate at 2.99, no, 3.25. He had a rate of 3.25, and he was going to be at 4.75. So he was trading in a loan for $200,000 for a $300,000 loan that was at 2.99, that now is at 4.75, and his property taxes doubled. The math added up that his housing payment was going to double when he went from a $400,000 home to a $450,000 home. Guess what he did? Absolutely nothing. He did not buy the home. He did not sell his home. He stayed put right where he was. Is that a good thing for him long-term? Sure. But did it create one less seller? Did it create a situation where somebody couldn't accomplish their goal because they wanted to move, but it wasn't worth it? That's the challenge we're going to run into as housing prices go up. The challenge, as interest rates go up. The challenge that I hear buyers and realtors telling me is, oh my gosh, John, I think that an increase in interest rates is going to slow down the number of buyers wanting to buy homes, because nobody's going to want to buy a home at 3.9% interest. Gang, when housing prices go up, somebody's house payment goes up. So when the house that you're selling them right now for $500,000 was worth $400,000 a year ago, are they still willing to buy it for $500,000 today? Sure are. And they're going to have a higher mortgage payment because they're borrowing more money. And if they would have bought the house a year ago, they'd have a lower mortgage payment. And they would have, and this is, by the way, is not taking into account rates. They would have had a lower mortgage payment because the house was a lower price, and they would have had to put less down payments. So every time house prices have gone up over the last 2 years, it's caused an increase in the buyer's house payments, and it's caused an increase in their down payments. But has that slowed down the number of buyers looking to buy homes? It has not. We still have a high number of buyers wanting to buy homes. So prices go up, they have a bigger monthly payment, they have a bigger down payment, and yet that didn't deter them from buying. Interest rates go up, they have a bigger monthly payment, but their down payment didn't change. So the impact, the real impact, not the emotional one, but the real impact of interest rates going up is no big deal, less of a deal than the impact of housing prices going up, because interest rates only affect your payment. An increase in house prices affects your payment and your down payments. People will continue to buy homes even with interest rates going up, but sellers are not going to want to sell. It's going to create a bigger problem because of that situation I explained about the guy that bought his home, was trying to sell the $400,000 home for $400,000 and buy a $450,000 home. That is going to prevent sellers from selling. We think we had sellers who didn't want to sell over the last 2 years. Watch what happens as rates keep going up. And those sellers are going to say, dude, I got a 2.5% interest rate. Why in the world am I going to trade that out for a 4.5% interest rate? I'm cool. I'm going to stay where I'm at right now. So that's my concern. So let's talk about the long-term outlook, guys. Remember, if you have questions, feel free to post them into chat. Hopefully this is valuable and good information. The good news is I only lost 2 of you in the last 30 minutes, so 40 minutes. So I feel good about that. All right, so what's the long-term outlook for housing prices, interest rates, the stock market, and economic cycles? Stock market, 2020 is going to be a rough year. We're already seeing it, and I don't think we've seen anywhere near the amount of pain we're going to see in the stock market. But here's the deal. Warren Buffett said, be fearful when others are greedy, be greedy when others are fearful. If you think back to March of 2020, everybody was fearful. The market dropped and you could have bought Zoom for cheap. And then April, May, June, Zoom starts taking off, Peloton takes off, everything's great. You could have made a boatload of money because everybody was afraid in March of 2020 about what was going to happen. And the people who jumped in and bought right then made a mince. Then we get later into 2020, early 2021, and everybody's like, oh my gosh, the stock market's on fire. I'm going to buy, I'm going to push it all in, and I'm going to bet everything on black. And I'm going to put all my money in the stock market. Stock market didn't go up anywhere near as much as if you would have put the money in March of 2020. And now we're seeing it drop again. The stock market is not a place to gamble. To me, it is a place to invest long-term. But if you happen to have money that you were thinking about putting in the stock market, the next few months would be a good time in general. Now, I'm not giving stock advice, even if I was a financial advisor, which I'm not. Financial advisors can't tell you what the market's going to do because nobody can predict the future. But I'm telling you that the stock market is going to have a rough year, in my opinion. A lot of people think the market's going to be back to its current levels by the end of the year. Remember, I said cycles are becoming shorter. So the drop is going to come quickly back if it follows that pattern. And if you're investing for the long term, I wouldn't be too concerned about whether it came back this year or next year. The stock market historically always rebounds. It's not if, it's when. Just don't speculate and buy that one fly-by-night stock, because that company may not be here in a year or two. But the market in general will stay strong. Best thing you can do is to kick a little bit of dirt down into the valley and you put some money in the S&P 500. That's my personal off-the-record non-financial advisor advice. S&P 500 is the top 500 stocks out there. You're buying a little bit of all the big guys, and you're going to ride the market pretty good. And now is a good time over the next couple of months to throw some money into the stock market. Be greedy when others are fearful. In other words, go after the opportunity. Where do I think we're going in the economic cycles? We're headed towards a recession. Okay, I've talked about this. I'm going to make it super clear. Inflation is leading to an overcorrection. They're going to increase interest rates and they're going to increase them fast. And the federal government, as I've said multiple times, has clearly said, we were going to take 6 to 9 months to sell off all of the mortgage bonds that we've been buying. We're going to accelerate that and do it in 3 months. So they're compressing. They are literally hitting the gas as hard as they can while they're yanking the steering wheel as hard as they can to the left. And that overcorrection is going to lead to an economic slowdown. I think we're in for a recession by 2024. And what is that? Again, it's when the economy starts to shrink, when there is less gross domestic product, when there's less value of goods and services produced. Now, if you haven't heard this saying, I love it. Truman said, it's a recession when your neighbor loses his job. It's a depression when you lose your own. That's not the real definition of a recession versus a depression, but it's really a truthful one. Anyway, it's a vicious cycle. People lose confidence, they spend less money, companies spend less money, they lay off, stocks fall, banks lend less money, which creates more loss of confidence, which creates a vicious cycle. And the question is, what does it take to break that cycle? Well, the Fed starts lowering interest rates. They start getting people to buy again because the Fed says recessions are bad, and they are. They want to give money to the market so that they can start investing for cheap. And that's going to cause interest rates to drop. Okay, so I'll talk for a quick second about how COVID plays into all of this. COVID's been the big wild card. Every time up until Omicron that there's been a spike in COVID numbers, the fear of the market is, oh my gosh, we're going to hit another recession because it's going to shut down the economy. And that has caused rates to fall. Except Omicron changed the plan. Omicron, now I'm not saying whether you believe this or not. I'm not telling you whether I believe it or not, but I'm telling you what the market is predicting. Omicron and the growth of the Omicron variant is, in the market's opinion, going to have more people infected and potentially be the last major variant that is going to give us any concern about having a lockdown again, a major economic shutdown. And so now the economy says, wait a second, COVID used to be a bad thing for the economy, a worrisome thing for the economy, and would cause rates to fall. But this variant of COVID is having the opposite impact. It's actually a positive in the eyes of the economy, and it's actually part of what's driving interest rates up. Okay, so hopefully that makes sense. So what's long-term with interest rates? Recessions cause interest rates to fall. Hopefully that makes sense based on what I've been talking about this far. The federal government, when we hit a recession, is going to lower interest rates in order to get the markets to start spending more money. And that's going to lower mortgage rates as well for the same reasons that those indicators and those problems cause rates to go up. That causes interest rates to go down. In a recession, interest rates drop. I personally think we have not seen 2.5% interest rates for the last time. I think, this is total crystal ball, I can't guarantee you this, but I'll tell you that I believe by 2024, we're going to see mortgage interest rates back in the twos, because this market cycle is going to significantly overcorrect. And that's when those people who want to buy up are going to make the move. That's when they're going to sell their home. Now, some are going to do it now, but those like that client I had back in 2018 are going to wait. And I think that we're going to see interest rates dipping into the 2% territory in the next 3 years. And I really think it'll happen before the end of 2024. So I'm going to finish up. We got 13 minutes left. I'm not going to take the whole time. I'm going to finish up with what's the long-term outlook for housing prices. A lot of people over the last 2 years were worried about forbearances and foreclosures and where we're going with all of that. I'm here to tell you it's a non-issue. The federal government, and if you guys came to my webinars that I did back in 2020, I was telling you, I don't think the government's going to let these homeowners fail. If back in 2008, the federal government would not let the banking industry fail because, hey, it was too important to the American economy to let the banking system fail, then how in the world is the federal government going to let the homeowners fail when they've lost their job or unable to work because of the pandemic? They were going to come up with a solution, and a solution they came up with. There are so many workout solutions. As a matter of fact, guys, and I know this much about it, but just the other day I was on the Cal HFA website and I saw that Cal HFA just launched a program where homeowners who are behind right now on their mortgage, and you had to be behind, I think, by 4 months as of December 31st, you can apply to Cal HFA to get a grant, free money, never have to pay it back, up to $80,000 to catch up your delinquent mortgage. So the government is not going to let homeowners fail. I don't care whether you think that's a good idea or not. I don't care whether you think politically that should happen or not. It's just a fact. It's a fact. The government is not going to let homeowners in general fail. We are not going to see a foreclosure crisis as a result of COVID. The second thing I think is going to happen with the housing market is a dynamic called household formations. And household formations is the statistic of people creating a household unit. So if you think about, you have children and they live in your home until they're 18 years old, and then they go off to college and they live in the dorms at college. You are one household, even when they're in college, because they aren't renting or owning a home of their own. They're still under your household. But once they graduate college, statistically, generationally, you graduate college and you move out on your own. You rent a home, you buy a home, that's what you do. Until 10 years ago, when the millennials said, oh my gosh, adulting? I don't want to do that. And so the millennials moved back home with mom and dad, or bought a place or rented a place with 14 of their other friends, and they refused to become adults. And they did not form a household, which means that there didn't need to be a home for them to live in by themselves. And that perfectly coincided with the housing market crash of the Great Recession. Builders had built a whole bunch of homes, they lost a bunch of money, and they decided, I'm out. I'm not building any more homes. And we did not see much new construction 10 years ago. It just wasn't happening. So it worked out perfect. No new construction, no new houses being added, no new apartments and rental units being added, but very few new households being added because everybody didn't want to be an adult and they moved back home with mom and dad. Until they're turning their mid-30s and they're deciding, yeah, I'd kind of like to get married and have a kid, and I feel like mom and dad's basement's cramping my style. They are in droves trying to buy homes or rent houses, apartments, etc. right now. The household formation numbers are projected to be significantly above average until around 2025. That's going to put demand, even if all of them rent. If that many more people want to rent, landlords are going to do what? Well, they're going to raise their rents. And that means the person that's been renting for 10 years says, man, my rent's gone up so much, I might as well buy. So even if the new household that's formed isn't a home buyer, they're taking up a rental unit that is putting pressure on the current tenants, the current people who are renting, that says, I might as well go buy a home if prices are going to keep going up like this. And they become buyers in the housing market, which pushes up housing prices. So I expect to see how pressure on housing prices stay up. I don't think we're going to see the significant increase that we saw in 2021. I'm starting to rethink that because it feels like 2022 is going to be another repeat of 2021 with the significant imbalance between demand and supply. So we'll have to see where 22 goes. But whether we see a significant increase or we just see a gradual increase, I don't think we're going to see a decline. And if we do see a decline, it's not going to be significant. So let's look a little bit at the housing prices and talk about how housing prices move as we wrap up this meeting. So what we're going to see right now is we're going to see back from 1963, and you're actually going to see two things. You're going to see the average sales price and you're going to see the median sales price. So the median sales price is halfway between the highest and the lowest. The average is literally they take every single house that was sold and they add them together and then divide by the number of houses that sold. It skews the numbers. I don't really care which one you look at. I just don't want somebody arguing with me saying, well, John, you used average instead of median or median instead of average. I used them both. They move in the same direction. And what you're seeing is even as housing prices dropped, in the 1990s, we saw housing prices drop, but housing prices did not drop and stay low. They dropped a little bit. I hate this little thing. But anyway, it dropped a little bit and then they start coming back up again. And so the drops historically over any 10-year timeline, I'm going to kind of do this down here. All right, perfect. Any 10-year timeline, housing prices are always higher. Even if we go from 2008 to 2018, you're still seeing housing prices higher over a 10-year time frame. There is not a single 10-year time frame in history where housing prices are lower than where they were previously. Even when we see dips, they jump right back up. So I am not concerned. We're going to see a cycle. Nothing ever goes in the same direction forever. It is the biggest problem with human nature is we think whatever is happening today, whether it's good or it's bad, it is never, ever, life is never, ever as good as you think it is, nor is it ever as bad as you think it is. Housing prices are never as good as you think they are, and they're never as bad as you think they are. The future of housing prices, never as good as you think they are, never as bad as you think they are. Things will change, there will be cycles, but over the long term, unless you're speculating and trying to flip homes, in which case you're going to be in trouble when it goes from here to here. But otherwise, if you're buying a home as a primary residence, as a place to live, now is absolutely a good time to buy. And the truth is, even in the next 3 years, I expect that we're not going to see any drop in housing prices. We're going to continue to see strength in housing prices because of household formations, and we're likely to see another recession before 2025. Recessions are actually overall good for house prices. And I think this will actually, I lost it. That's awesome. Anyway, I was going to talk about questions. Let's just go with questions. So I'm done. I'll put this over here so that we can have the question screen because I just escaped out of my PowerPoint. I'm usually good at managing PowerPoint. Anyway, the bottom line, gang, is I think right now is an amazing time to buy a home. I think that we're going to continue to see housing prices increase over the next 3 years. And if and when that recession comes that I expect it to come, we're actually going to see more buyers coming back into the market, especially those buyers that had a home they chose not to sell while rates were high. So hopefully this has been valuable information. I've got 5 minutes. If you guys have questions about anything, feel free to post the questions in chat. If you want to unmute yourself and ask me a question, feel free to do that as well. Don't forget to share this. So go to youtube.com/JohnLoanKing tomorrow and check out my YouTube video on this and share it with everybody you know that you think could use this information. And I look forward to helping you guys out. So if you have questions, I'm going to keep talking to myself and filling time while I'm waiting to see if anybody has questions. Aside from that, guys, I really do appreciate your time. Don't forget, I am here to not only give you amazing information, but to take care of your buyers on mortgages. So if you know somebody who needs great advice, that is the best way you can repay me for the amazing advice I've given you today, is to send me your buyers. I would really, my team and I would take great care of them, and I look forward to the honor of taking great care of you and your buyers. So thank you, gang. I think we're pretty much got no questions because I've been thanking people for the last 2 minutes and nobody said anything. So I'm out. Y'all have an amazing day and we'll talk to you soon. Bye-bye.